So yeah, we're going to talk about the One Big Beautiful Bill, and it's been my pleasure here to talk to you. This is going to be focused both on owners and advisors to manufacturing companies. Tax policy directly shapes your cash flow. It affects your ability to reinvest in equipment and plan for growth. So this bill does all of that. So the legislation was designed to simplify some aspects of the code. Now I told you, simplify, it's never simple. So let's not keep that as a bar. It's intended to be a little bit simpler. But that means that there's going to be opportunities for tax credits and investments in machinery, but also more reporting standards in some respects. So what we're going to talk about today is some of these key provisions that are more relevant in our eyes to the manufacturing space. And hopefully you'll leave today with some more clarity and things to bring back to your own business. So we'll talk about things that are stable. So I like this heat map presentation that we've got different types of businesses see different types of stability based on the way you form business. The C Corp status, the traditional standalone entity paying their own tax. In our space, the managing through the pass-through entities is very common, whether it's partnership or S corporation standpoint, and some of these other things that are kind of in the stability realm. So I'll say this: they kept C Corp tax rates stable at 21%. That came back in effect in 2017, and that is good for some of our growing businesses. They kept the qualified business income deduction, or QBI, which again is a very key important impact for our smaller businesses. That is a 20% deduction on qualifying income. Again, that puts us in a much more stable and competitive position to keep the tax rate, effective tax rate down. Now, I'll say this about the tax code. The rate gets a lot of attention. What is the actual tax rate? But what a lot of things happen in the background is they change the base on which the taxes are calculated on, because it's a lot harder for people to actually see what was going on. Your income might not be low. Sorry, your income might be low, but you might have a high tax rate. That doesn't look good to people. But if your income base is high and you have a low tax rate, you still have a lot more income. So that QBI helps alleviate that. There's stability in loss position. Now, unfortunately, Buckley spoke to the optimism of manufacturers. There are companies that still lose money, whether that's from big investments into their asset base or the ebbs and flows of business. There has been a limitation over the past few years that you could only take 500,000 plus of losses. So that didn't necessarily have a really big impact, you thought, by an investment into the business. You'd have things that are carried over. In our world as a tax accountant, just because it was spent doesn't always mean it's a deduction that year. So we have to plan around that. But what they have done is they have put that into place now. They've increased it to 626,000. So there is still more impact on how we get to use losses and when we get to use losses. So as we talk about stability, that helps us know how we plan and when we plan to have expenses hit the income statement. There's another stable piece that is specific to C Corps. It's referred to as Section 1202, or qualified small business stock. Now, I made it a point saying that pass-through entities like partnerships and S corporations are the common way that entities do business for small manufacturers, not the C Corp. The play on this is they are incentivizing people to do C corporations and stay in them for at least 3 years before selling and exiting. What they are continuing to offer is the opportunity to have a potentially tax-free or tax-limited gain on the exit of the company. So for example, if you started a brand new C corporation after July 4th of 2025, and you held that for 3 years and then sold it at a gain, you could get 50% of your gain not taxed. If you held it for 4 years, 75%. 5 years, potentially 100%. So this has been in place since the 90s, but people know C corporations, you have to have, you get a lower tax rate in the C corporation, but you have the double tax when you have money coming out. So this is partially to counteract that double tax impact. We'll talk a little bit more of that about that at the end. Capital investment. We saw in Buckley's slides, people were not very eager to spend money in the manufacturing space, but they have then put incentives back into this place. Bonus depreciation is now back on the table. This has been sliding down. Where it used to be 100% you could deduct, then it was 80, and then 60 and 40, and it was a sliding scale. They're reverting that back to 100% that you could take on the qualifying assets. Very good for manufacturers. Again, you can use this with loan situation, get your 5-year loan, take your deduction now, pay for it over time. Very good strategy. The new concept is qualified production property. I think that has gotten a little bit more publicity. This is actually building the building itself for the manufacturing space, whether it's expansions or new buildings. They're putting in the incentive over the next 5 years to immediately deduct your manufacturing space. Now, there's still some rules to be clarified about that, about what's going to be considered manufacturing. I mean, everybody knows an office in a building won't be that, but what about your storage and warehouse, your receiving, quality control areas? So we're still waiting for some of those clarifications from the IRS about how they're going to define it, whether it's going to be very broad or very narrow. So more to come on that. In an expansion situation, I think that'll be pretty important to kind of know what you're getting into. And I would imagine there will be a lot of logistics going into place of, well, I built a manufacturing facility and I moved everything else to an existing part. So you could capture it as manufacturing. That's one of the biggest impacts to me in this whole bill, is something that would be deducted over 39 years could be deducted immediately. There are still some energy efficiency deductions under 179D, which is more of the energy efficient lighting we see more often than anything, replacing lighting, getting more efficient, and some cost savings. So those are starting to tail off. Some of the items that related to energy and the fuel or the electric vehicles, some of those things have kind of tailed off. But these incentives are really good for manufacturers, that they now know what the rules of the game are going to be. One of the most disruptive aspects of the past 5 years has been research and experimentation, or referring to as Section 174. I know we've had plenty of uncomfortable conversations with clients. This has been one of the biggest impacts from the earlier tax bill going back to 2022, that expenses that were incurred had to be capitalized and amortized over a 5-year period. So that was disruptive and damaging, if you want to say, at the high end. I mean, we've known of people who've had to actually take loans in order to pay the tax obligation when they've actually spent all the money. So that was kind of a ridiculous situation, but I tell everybody that was in play from the 2017 Tax Cuts and Jobs Act. It was a balancing mechanism that both sides of the aisle thought, we'll never get there. And they got there, and they couldn't agree on changing it. So this is very impactful for that. So what's going right with this is the small manufacturers, or approximately 31 million and under, have some opportunities of what they want to do with this. They are sitting on a big asset tax-wise of costs that have been incurred, and to choose when you're going to deduct them. There's opportunities to go back and amend returns and get some money back. That sounds good. There's also opportunities to deduct it all in 2025 or spread it out evenly in 2025 and 2026. That sounds good. You have the opportunity just to kind of take that mechanism and expense it when it was originally scheduled to go. That sounds good. Okay, that sounds very non-committal, but what those are all opportunities. to take other income and plan for when you want to have these deductions come into place. So we've talked about clients with Roth conversions. That is a common piece, to get something done for 2025, offset income coming in deliberately, offsetting with the business expenses. So very good strategy there. The IRS also streamlined how this amendment process works with a partnership. Okay, this is a little bit the technical world of tax accounting, but amending a corporate return is a lot easier than amending a partnership return based on the number of forms and how they push that out. So needless to say, they've made it a little bit easier and less costly to amend a partnership return these days. Now, the large business situation, they can only go forward. You don't have the options to go back. But going forward, again, you know what the rules of the game are. These are expenses that people have put money out for, and you get your deduction for them. So you don't longer have to do this adjustment. Financing and debt. This is not something that maybe a lot of people knew in the smaller business world, but the larger manufacturing entities have had limitations on when interest expense could be deducted. And it was a base that started with an EBITDA calculation, or earnings before interest, taxes, depreciation. That was in play for a few years as a base. So EBITDA, should be a pretty high number. We all want it to be a high number in our business. When it was a high number, the base didn't get as much of a limitation. Then over a couple of years, like I referred to on the 174, it was a balancing mechanism. This was kind of the same thing. Then it became a calculation of EBIT. Well, when you don't add back depreciation for a manufacturer, which is heavy in depreciation in the first place, that base in which this calculation came into play caused more limitations on interest, more surprises. So again, they didn't change the tax rate, they just changed what your tax base was. So this reverses that, puts it back into an even footing to go with an EBITDA calculation. Doesn't take it off completely, but it is a little bit more fair. So it is now a variable that continues to be at play. When do we want to have depreciation? I talked earlier that we have all these opportunities to do acceleration. Well, depending on what the series of acquisitions is supposed to be, maybe you don't take that, or maybe you don't want to create the loss. So we've got a little bit more in play of what variables need to come into the equation to get the answer that we want to get to. So I like this adjustment. That's a little bit more fair. Oh, and they also took out a loophole that has been used for a short time with the concept of capitalizing interest into your inventory, basically saying you had to get loans to make your inventory. So you'd pump up your inventory volume and then sell it, and you would actually be deducting it as cost of goods sold, not as interest expense. So that was a way to get around it. They closed that loophole too. So if it seems like it's be so good to do it, you probably can't. So some very smart people found that one. In the global space, I am not an expert in global taxation. We have resources which we call upon for that. But what is broadly happening is they are replacing this guilty global intangible low tax income regimen with a controlled foreign corporation setup. They're trying to cast a wider net to pull more income into the United States. The U.S. is a worldwide taxable income theory. They don't just say tax U.S., they tax everything and then have a credit system. So it makes it a little more complex to deal with. They start a really big number, and then you have to prove why you have to pay less instead of just starting with a lower number. But this is consistent with the administration and consistent with the tariff policy to try to bring things back in the United States, because there has been a big exodus of pushing things out to other parts of the world for tax efficiency. So getting the tax policy straight where it makes it competitive pushes those things back into the United States. Since most of our manufacturers are using the S corporation or the partnership model to operate, we'd be remiss if we didn't talk about some of the individual income tax impact. The state tax deduction, whether it's for real estate taxes or personal income taxes, has increased from 10 to 40,000. That's meaningful. For many people, there was a pass-through entity tax election that was made that the entity itself would pay state taxes deducted on the federal return to start with a lower number for federal. That strategy still is in play. I think this is going to help a lot of people that have high real estate taxes that really had no impact for a number of years. And it'll also impact some people who have had some higher wages that maybe are not necessarily manufacturing, but people who take home a lot of wages still have that impact. The no tax on overtime. Okay, no tax is a misnomer. It sounds really good in a campaign trail, but it is still impactful for a lot of rank and file manufacturing employees, that there is a deduction of potentially up to 25,000 of their overtime premium. Now that's the important aspect that maybe everybody doesn't remember. It's the premium part, or the half and time and a half. Yeah, for a lot of manufacturers, they have relied on the overtime of employees, so they've done pretty well for themselves by putting in that extra effort. This is a good reward for those employees, and it kind of does impact hiring decisions. I mean, maybe they would work harder, maybe they would work longer if they know they're not going to have as much tax on it. But again, it's a value judgment, but it's another option that's in play. Car loan interest got a lot of notoriety on the campaign trail. Again, that has limitations of your income in which you can take it. I don't expect it's going to actually have that much impact to deduct some loan interest, but depending on the situation of the owner, we talked about how these opportunities to bring business income down, perhaps that's going to come into play. You know, you've got a small wage, you've tactically taken a lot of losses, those things might come into play for that particular year. And they've also kept the mortgage interest base of 750,000 for your home. So again, there's limitations that are in play, not changing the tax rate, but limiting how much you can deduct. So strategy and timing and takeaways. Timing is everything. What we're going to ask for more is that crystal ball to know what you think income's going to be and all the elements that build that up. That starts a lot with depreciation and when your acquisitions are going to happen for capital equipment. If you have a plan of how that's going to go over the next few years, that is the biggest variable outside of actual production. So we want to know what you think you're going to spend. So we've seen the impact of the demographics are saying we don't have enough employees. I think it's a logical next step to have to automate. The impact that I took away out of this whole bill is this Section 1202 stock, which we talked a little bit earlier on this qualified small business stock. I emphasize many people are working as S corporations or partnerships. They're not working as C corporations. My mind was kind of blown with the concept of some restructuring that can happen to take that corporation or the S corporation, those assets, form a new C corporation that's owned, essentially dropping down those assets and kind of restarting the clock on that company. And then holding it for your 3 to 5 years and selling it. Now, that sounds awesome. Wouldn't you just say, I want to work as a S corporation or a pass through. I could take out all my money without double tax, and then I could sell it on the back end at a potentially no tax or limited tax. That does sound great. There is some concepts in place that the value on that conversion, that gain wouldn't get taxed. So there's a lot of discussion to be had about what the value of the company is now, what you potentially want to be doing with the company. Are you going generations for generations and passing it down? Maybe this isn't attractive. Do you have an exit that's coming up in the next 5 to 7 years? And you know that these next to 5, 7 years are really going to blow up. You're going to hit it. Then something like this becomes a lot more attractive. But it's another tool in the toolbox that came out of this bill that I think has a lot more applicability if we see the benefits of this investment and the return of profitability for manufacturers. So there's a lot here. I mean, for us, it seems like it's old hat. You know, there's rules, we follow them. There's rules, we try to go around them, try to stay gray, not always black and white, but there is a lot more variables to it. And I think that this bill has been very positive for our manufacturing base. So planning, that's all what it comes down to, is planning what your crystal ball tells you. Thank you.